Hey everyone, it's Imran from Options Insight. This is a quick message to let you know we've got our options trading bootcamp happening this weekend, 29th and 30th of April. If you're worried about the potential recession, this is the time you want to learn how to weatherproof your portfolio. Okay, who knows where the bottom is in this thing? 3,800 on the S&P, 3,200 on the S&P. There's multiple targets out there. In this bootcamp, I teach you how to hedge your portfolio. I teach you multiple techniques, whether it's long vol, short skew. These are things you need to know how to navigate market swings. So come and check us out at our website, optionsinsight.com. This is an opportunity you don't want to miss. And happy Friday. This is your final chance to sign up to our bootcamp, okay? Anyway, what's been going on in this market? Pretty choppy moves yesterday. Markets were in upbeat mood. We had the S&P up 2%, NASDAQ up nearly 3%. Generally better than expected earnings coming out from all over the place, carrying the indices higher. Amazon was very choppy though. It spiked like 9-10% after hours, only to give it all back and some and finish showing down now from where we closed on weaker guidance around their cloud business, AWS. So this was the thing we were concerned about. We were like, yes, Microsoft and Google are gaining share. Is that at the expense of Amazon? They seem to confirm that that's the trend that they're seeing, basically. Okay, Europe trading softer as well on some weaker growth data, weaker than expected. And China was firmer. Commodities did hold up, but they were far less impressive than stocks and not really managing particularly large gains. Best performers really were gold miners up 1.5%, and then we saw uranium having a decent 2% pop. Volatility-wise, Vols were hammered, as you generally see when the market trades up. So we saw S&P Vol down 2.5 points, which is a pretty huge move for a day, and we're seeing that VIX level testing 17 again. Commodity vols were also down, pretty heavy, except for copper, which is already at the lows in vol that we've seen in quite some time. Positive carry wiped out in S&P and NASDAQ. You can see that here. Those green bars have disappeared, but look at Europe. Europe's very much in deep positive because these single-digit realized vol numbers, right? Europe just can't really seem to get any big swings going, whereas the US, having that concentration in the mega cap techs in terms of how much of a large weighting they are in the indices, that's really swinging things around. And then looking at commodity carry, we are seeing lots of green as well, except for nat gas, which is kind of only marginally positive. And that again is with implied vols at 1-year lows in natural gas, around the 60 level or low 60s. Skew did come down. We have been saying skew's been pretty firm lately. Markets obviously ripping higher, alleviating some of those bearish fears. VVIX is also mean reverting. Remember, VVIX caught a strong bid last week. Got about near 100 odd, and that is coming back down. Some profit being taken on some short dated VIX calls, so that's helping there. And then gold miners and gold skew was firmer in commodities, not massively, but we saw oil and nat gas skew softer. Okay, looking at the charts. So mega cap tech really rules, but semis could offer some value. Okay, so far the mega caps have delivered on earnings. Strong year-to-date outperformance by the big five. You see Facebook's up 100%. The other names are up about 20 to 30%. Although Amazon's guidance obviously did spook investors, which saw the stock give back that 10% rally pretty quickly last night. Now, with all the excitement around AI, another beneficiary should be the semiconductor space, as the need for chips is going to explode as more people embrace this technology. Okay, so it is a chip intensive industry. Okay, now we do think the underperformance in SMH. We look at SMH versus NASDAQ. They're kind of tracking each other pretty well all year, except recently there's been a bit of a break in that correlation with these mega caps. Okay, so we do think that is reflective of some demand concerns around oncoming recession, things like that weighing on it. We're seeing the Kospi selling off a bit as well. Some of those leading Asian indices have shown some weakness. Now, we think it'll probably be okay in terms of AMD and NVIDIA reporting in May. They may well have similar sort of responses, and the stocks could rally. and bring that sector back to life, right? So we wouldn't be surprised to see SMH have a bit of a catch up once AMD reports next week and maybe Nvidia towards the end of the month in May. We think buying dips in semis for the long term is likely to be a decent strategy. So even if it's not a short-term tactical buy, if it needs to work through some more weakness because of the trend in AI and what is going to come and this revolution being inevitable, we do think buying dips in this for the long term probably does make sense. As we said in yesterday's note, though, there's a hell of a lot of hype right now. And that's why we just think being on the lookout for what to buy when and if there is a crowded positioning unwind is what you want to do, right? A lot of what we talk about is idea generation, but it's not saying go and do this trade immediately, right? It's about knowing what to have on the radar. It's about looking at various relationships, how things trade against each other. And then when you know on a day when the market is down 3 to 5% and everyone's panicking and you want to get your shopping list out and buy stuff that's being offered to you cheaply, then you've already done the work to figure out what you want to get into. So this is the idea, to provoke those sort of preparations. Okay. And then obviously option structures are always a great way of participating with a limited premium, allows you to, get involved with a little slither of capital without committing too much. When you want to really step in and buy a lot of exposure for the long term will be when the market sells off. Okay. But here you might be like, I don't want to miss it if it does recover on these AMD earnings next week. So maybe I'll buy a few calls or call spreads just to participate. And that's the nice thing that options allow you to do. Okay. Right. Next one. What are we looking at? So we're looking at Nat Gas again. We looked at it last week or a few days ago. But there's some more stuff to say here, right? So Nat Gas, a month ago, we initiated a long exposure. How did we do it? We sold put spreads in May and we bought call ratios. It was a net short Vega trade. It was a zero cost trade at the time. Spot was at around $7 in UNG, the ETF for Nat Gas. We limited our risk by selling a $1 wide put spread. And the only way that put spread was going to max out against us was if the thing dropped 30%. And then on the upside, we would kick into some reasonable money if the thing traded up towards $10. Since then, spot hasn't done anything. It did trade down 10%, but then recovered back to about unchanged. But the main move has been implied vol. Implied vols got absolutely annihilated by about 20 vol points in the last month. And skew has also come down from about 10 vols for puts to only a couple of vols for puts right now. So downside options have really taken the brunt of it. Now, on the 24th of April daily note, we explained why we thought it made sense to cover the upside tail. Remember, we did call ratios. So we covered the upside tail. And we also rolled our long calls that were in May into June. So that just extended the life of our trade, rolled up the strike a little bit. But we thought parking ourselves in June upside gave us a bit of time for the rally to materialize. And we didn't want any of that upside tail risk in case the thing really starts to go. And we know that when natural gas wants to go, it can double in a month if it really wants to. Okay. I'm not saying that's going to happen, but we know it has happened in previous times. Now, another factor to consider when thinking about this UNG ETF, because this is our expression of the trade, is the futures role. So UNG is essentially an ETF that holds front month futures in natural gas and it rolls them every month. The problem with having an ETF like that is that the roll could be costly. So you can see here, UNG is the green line and the orange line is the nat gas spot price. And over the last month, we've basically underperformed by about 4% in UNG. And that is because of the roll cost. Because if we look at the roll cost right now, the roll cost, and this is the slope of the futures term structure at different periods in history. And right now it's upward sloping. Okay, so this today, a week ago, a month ago, it's been in this upward sloping shape for quite some time. It did get inverted, like when natural gas was going crazy, and it can get inverted, but it doesn't tend to stay there for that long. Another way of looking at that is the spread between the natural gas second contract and first contract. And you can see that spends a lot of time in green, and it has been in green pretty much since the end of January. So we can see here, and right now it's around 20 cents. So that means you're spending 20 cents to roll from the first contract to the second contract. And 20 cents as a percentage of the natural gas price is roughly 8%. So your roll cost is roughly 8% per month right now if you're long futures and you're rolling them into the next month as they come due. So that's quite an expensive roll cost, and that explains why UNG as an ETF underperforms the spot price. Okay, so that's just something we need to be aware of. When we're long UNG, we are experiencing that negative roll cost, and we should be aware of that. Okay, Vol dashboard here on that gas shows us spot is obviously kind of parked itself at the lows. The Vol obviously has collapsed, as we've already said. The carry's pretty neutral right now, and the skew has softened from the highs at 10 back to actually something quite reasonable, closer to 0. Okay, and you look at the term structure. Term structure is absolutely collapsed. Okay, so the vol curve is just shifting down, and it's done it in some serious size. Okay, so vol for me, vol in natural gas is looking very, very cheap, right? And when you see the market finding a range at the bottom and vol gets really crushed, to me that signals signs of downside exhaustion. Okay, so it makes me still fairly bullish. Okay, now what would I do to manage the trade? All right, that's it for today. Hopefully I'll see you guys on my boot camp this weekend. I'll catch you all next week. Thanks a lot.